Most traders don't struggle because they pick bad stocks. They struggle because they're guessing market timing. They're either too early or too late when the market trend changes. After trading the 2000 and 2008 crashes, one thing became absolutely clear. Indicators don't fail, decisions do. In this video, I'll show you simple early warning tools for market timing I use to know when to be ready, when to act, and when not to act. So decisions stop feeling like guesses. Would you believe that line charts like this have been around since 1786? We owe them to a British economist named Billy Playfair. Billy was showing economic information using line charts, but what did he really determine off this? How many clues? And for hundreds of years, people would spend every day getting their little close for the day, draw their little dot on the chart, and then what would they do? They would connect the dots. And since that time, the charts have improved dramatically, but thousands of stock indicators or chart indicators have been added, trying to provide traders with just a little bit of an extra edge on how to predict where we're going to get reversals, either at the top or at the bottom. And I'm going to show you today just three different tools. A couple of them are indicators, and then there's some cues that I also use. And so we have jumped quickly from this to this, candlestick charts. Now you think candlestick charts, they've been around for what, 30, 40, 50 years? No, they go back to the 1700s. Each improvement helped traders better define their edge, when to trade, when not to trade. What's really funny is there were still people losing in the market. There were still people who wouldn't read the charts, didn't know how to read the charts. And so one of the first things that I like to look at is momentum. Momentum gives us some really absolutely fantastic clues. And here's a momentum indicator I love to use. Are you ready for it? My momentum indicator that I love to use is TSI, which stands for True Strength Index. As you can see, it's drawn on here. Now, you can find the True Strength Index on many charting platforms, but it comes loaded with a certain setting that the engineer in me, of course, had to monkey around with. And I came up with something that is actually more accurate in showing where momentum shifts and also ties into how the price action shifts. As you can see here, this is a chart of the TQQQ. We see the lows, but how do I know that that's the low to buy? Well, one of the things we want to look at is very simply is what's going on here with the TSI momentum. And as you can see, in this particular case, it got below the zero line. As you see, at these lows, the TSI was starting to turn back up. And so that makes it a great level to be watching, because the TSI turning back up is a direct confirmation that, price action momentum has shifted. I want to be ready to trade. A couple of things, as I mentioned, the one that comes with the regular charting software, I changed it. My settings on this is 883. And as you can see, multiple times, the deeper that TSI gets down into the reversal zone that's below the zero line, oftentimes the stronger the rebound. Like we see here, that happened in November this past year. TQQ went on a nice tear to the upside after that strong reversal. Notice it also can help keep us out of the trades simply because right here, price action looked like they wanted to take off. However, there was no cross on the TSI. So I utilized the TSI along with price action to give me an edge on when I get in. What are some of the other benefits of using TSI? Well, one is positive and negative divergence. We made a high of the market right here. Then we went on to make a higher high and another higher high over here. However, momentum still wasn't as high as it was back at this point here. And so these highs were very suspect in that, are they going to reverse and head back down? And sure enough, that's exactly what happened after this top. And we pulled back down to here, a nice move up. The other key thing that I really love about utilizing the TSI is not only does it show me negative divergence and also positive divergence, but it's also very good for trending. As you see here, we came up, tried to take this out, didn't do it, popped on down. And so what this helps us do is keep patience in our trading until we get this final clue. This is coming up off the bottom from the lower reversal zone where momentum is heavily oversold. As you can see, the 8-day moving average and the 20-day moving average came together, crossed, coinciding very directly with the TSI pullback. But the other thing we can do with the moving averages is they work, once you get into an uptrend, they often work as support. And you'll notice we get our breakout. What happens? The very next day, it pulls back and hits off the 8 and the 20, runs up a little bit, again, pulls back, in this case, to the 8-day moving average. Again, it pulls back, this time closer to the 20-day moving average. And so as I take a look at the structure of my chart, and I am in an uptrend, as you see there, I look for those pullbacks into the moving averages. And again, the 8, the 20 provides me some information, with the 20 being the more powerful of the two moving averages. The next moving average I add in is the 50-day EMA, and that completes our short-term moving averages. And these three moving averages are the ones I use to trade primarily my swing trades. They function very similarly. As you can see, on the way up, TQQ from last May, it came back and bounced against the 50 multiple times. Now, on the first part of the way up, that's totally okay. But then as you see, we get up here into this higher levels, it starts hitting off it more often, eventually hammering down the 50-day moving average and the other moving averages, and then moving sideways for several weeks and multiple months. So how do I trade the 50-day moving average? It's kind of like that intermediate zone between a short-term holding and a long-term holding. When prices get above the 50, that's typically a positive indication that prices are going to continue to move up as long as price action stays above the 50. So there's, as you see here, that's the roll up to the upside. In this particular case, I've lost my support. So when I interpret this, I go, okay, I'm in a weak sideways market. That tells me my moving averages don't work as well for support or resistance until I get a trend going. So the moving averages tend to work best for support and resistance when there is a actual strong trend going on. The 200-day simple moving average is the last thing I add to my charts. And I use that just as a reference point, because if prices are above the 200-day moving average and the 50-day moving average is above the 200-day moving average, that's an indication that we are still in a bullish trend. And so I use that as kind of my green light, red light. If it is a green light in that the 50 is above the 200-day moving average, then I have a green light up here. And I should be looking to trade pullbacks. Pullbacks into what? Pullbacks into past support and or moving averages. You get a lot of them there. The thing that in utilizing these indicators and the cues I'm going to be providing here shortly is that these also, I would say, they help with your, what I'll call the patience quotient, because while we may have a green light, it turns yellow when it's pulling back into the moving averages until it rebounds and bounces. Okay, I'll mention it very quickly, is I get a lot of questions from traders asking me, what about the weekly charts or the monthly charts? How do I set that up to trade on that? Well, here's a little hack if you're ready for it, and I'll provide it for you here shortly, and I think you'll like it. The question I have for you right now is, with momentum shifting and trend structure defined by the moving averages, wouldn't you want a third piece that helps define risk and limits? And that's exactly what we're going to be showing up in the next section. Hey, if you're finding some value in this video, hit the subscribe so you'll be notified. I put out a new video every week, sometimes two, and it's talking about technical analysis, and I love to talk about TQQ, so don't miss those. And we've talked about the indicator, but what else can provide clues into where to take action, either at the top or the bottom? And that's where I use trend lines. I look at both the horizontal trend lines and the slope trend lines. The slope trend lines help me determine whether I'm in a uptrend, downtrend, or maybe I'm in a flag, maybe I'm in a pullback. The way I use them, one, is to identify levels of support. I come across and I start drawing from where I had past support. When I come down, it looks like I've hit a new low. I look back to the left. Was there support? And support doesn't have to be just a single price point. It oftentimes is a range. And it oftentimes coincides with a consolidation pattern in the past. And it's a logical place for price actions to stop. What does this tell us as traders? It tells us that one, my uptrend in this case is still intact because my moving averages are heading up. It also then tells me that that's a level where a bunch of buyers came in over here, whether that be a bot buyer or institutions or even some retail buyers, they supported it. Price fell to that level, they supported it again. So that's one way to utilize the support lines. Well, what happens when it turns it from support into a level of resistance? Again, what I look back at is here was a little high, and I look back over here and say, okay, that's a little bit below that. This could be a zone of resistance where it basically starts to fall from there. The other area we can utilize the trend lines is to define pullbacks, or some people call them pullbacks, dips. And so here's a really nice one. What I'm looking for is a really nice uniform pullback. Note, I had a clue here, and this was actually two clues because that's a hammer. And I won't be talking about candlestick patterns right now, but that hammer is telling us that, okay, yeah, this could be a reversal zone. And then our final clue is when price action breaks back above that flag line, and then we're off on our way again. Now, on the flip side of that, what about the uptrend lines when they're broken? Well, here's a good example here. As you see, price action took off from here, and this is art and science of drawing your trend lines. There's a trend line there that you could draw in. And as you see, what clues did we get from there? What cues did we have to exit a trade? Well, one, trend line, we found support here. Great. But then once it got up in here and broke the trend line, what's going on down below? Bearish divergence. TSI breaks to the downside. Isn't that cool? I mean, that is really totally cool how all these work out. Where did it stop? Well, it stopped that level there. Look to your left. Oh, by golly, past support. Take a note how both the trend structure, the price action structure, and the momentum structure can all tie together to provide some wonderful clues and cues on when to enter a trade. They also help paint the story about expectations and help us set our expectations. Note that when I'm in a nice uptrend like we have over here, everything's orderly. The moving averages, the 50 is above the 200, the 20 is above the 50, and the 8 is above the 20. So the stack of the moving averages are all moving in the right direction. What else is there? The TSI. Again, all set up, orderly, moving straight up. Then also the trend itself. You're getting these long swoops of trend lines heading to the upside. And then what happens? Well, then what happens is we get over into this stuff over here, where price action, yeah, it kind of trends a little bit, but as you can see, the trends are getting tighter. Notice the moving averages are starting to turn into what I call spaghetti moving averages. And so it's a mess. I can't use them with any consistency to determine what price action might be doing because my probabilities go out the window when I'm in one of these horizontal zones. In this area here is when you can get eat up and chopped up if you're trying to trade what you would normally do in a full-blown uptrend. So I hope that helps you stay out of the meat grinder. You'll have to come back on a future video and I will explain why that's the meat grinder that chews us up. Okay, guys, if you want to know more about me, I'm Dennis Wilborn. You can find out at AutoPilotTraders.com. Go check us out over there. And of course, the YouTube channel here. And I describe each one of these entries and each one of these things in my book, Trade Your Way to Freedom. So you might want to check out a copy of that. Let me know some aha moments that you've had from this video. And stay tuned because this is a 3-part series with the next video being specifically how to use all these clues for picking market bottom.